India's front-loaded its borrowing program in FY20. The aim is to raise 4.42 lakh crores from the markets by the end of September. That's a jump of more than 50% versus the last financial year. It also comes at a time when the fiscal deficit number stands at an alarming 134% of the target at the end of February, that is. So a lot riding on advance tax collections and GST collections in March. The Indian bond yields probably started factoring in higher borrowing targets as well. Though you could argue that they have been largely flattish in the recent past, from last policy until this policy or thereabouts. Joining us now to talk about this in greater detail is Suyash Chaudhary, Head of Fixed Income at IDFC AMC. Suyash, good having you. Thanks much for joining in. Well, we wanted to do this discussion 2 days on a trot. The borrowing calendar kept on getting postponed. But now finally we are there. Marginally higher than estimates, and what kind of impact on yields?
So absolutely, the government has been kind of struggling with balancing the fist for some time. It probably dates back to the last year where GST has consistently underwhelmed targets, and therefore probably there's around 50 basis point of fiscal space that has hence gotten compromised. It is reflected not just in the borrowings of the central government, but if you see the borrowings via public sector enterprises. So our sense is probably some bit of central government expenditure, which ordinarily would have borrowed through the central government, is being passed on to public sector enterprise and funded via that. So crowding out is a bit of an issue for the bond market. If you look at it another way, for the last 2 years, inflation is sub 4%. Had we spoken about this 2 years back, and had you asked me that for 2 years running inflation is going to be sub 4, I'd probably have told you that 10-year government bonds would have been at 6 or 6.5, and we are closer to 7.5 as things stand, and that's largely reflective of the significant crowding out of the fixed income market. So this is a policy issue in some sense. Another way to look at it is that the economy is getting a real interest rate shock. So inflation has fallen, but nominal yields are higher. So yes, in the micro context, the higher borrowing is a challenge. But in the macro context, this has been a challenge for some time now.
And looks like it will continue to remain a challenge. I was just looking at the repayment schedule as well. Doesn't seem like it's easing in a hurry.
And
no,
these are big numbers.
Yeah.
Yes. So yeah, you're right. I mean, going into the next few years, it does become a bit of an issue. And fundamentally, it kind of boils down to the fact that, given that globally savings are reasonably plentiful, given that we are at the end of a reasonably large quantitative easing cycle across 3 large central bankers, probably we can do a more efficient job of tapping that global savings pool. So if India has a higher ask of, let's say, infrastructure spending, there could be conduits through which, via sovereign or sovereign guarantee, some of that money can be tapped to India. Alternatively, our own households' financial savings needs to rise. But as things stand, this equilibrium is slightly less than tenable. As long as inflation is low and globally things are benign, your nominal yields are getting anchored. But like I said, on a real yield basis, India has already seen a substantial rise, which is not very optimal if you were to look at long-term opportunities for financing. And this is something that needs to be rectified, like I said.
All right, so how would you anticipate the movement of the yield curve in the first half of FY20, considering expectations of rate cuts, investor interest at the shorter end, lack of demand at the far end? How would all these variables play out? Probably you can give me a range.
So if you see, the shape of the yield curve has been almost continuously steepening. So far it's a bull steepening because the long end is also getting reasonably anchored owing to the factors that you mentioned, market expects a rate cut, etc. Interestingly, if you see the corporate bond curve as well, the 5x10 spread is around 60 basis points now, which is kind of higher than what we have historically seen. I mean, on the 10-year sovereign standpoint, we expect yields to remain relatively well anchored. If you were to ask for a wide range, it would probably be 7 to 740 types on the new 10-year or 7 to 7.5. Depends whether supply at some juncture starts to overwhelm us. But clearly, one other aspect of this is globally things are very soft. Major central bankers have turned dovish, chiefly the ECB and the US Fed. And we do think that locally also the growth inflation trade-off is kind of asking for further easing. And we think the new central bank governor in India has probably a more emphatic reaction function that we have seen so far. So, probably his attempt at ensuring better transmission is going to be more emphatic, and that would have some rub-offs on bond yields as well.
All right, so you mentioned supply there, and, how is the realignment of supply across various categories based on the investor interest, obviously the shorter dated ones, segments from the 1 to 4 year segment is seeing a bigger supply. The supply has increased 8 to 8.8%, I think, at the total of the first half of 20, from 8.3% in the first half of FY19. Will that sort of change or skew things?
Not much, because there is a natural interest at the shorter end of the curve. So people are worried about fiscal, people are worried about excess bond supply, but at the same time, everyone is more confident about liquidity, as well as the fact that the repo rate is probably going to go down. Our own sense is between 50 and 75 basis more in this cycle. Could be just 25 in the upcoming policy, but there's more in the pipeline. So front-end rates, there's much more anchor. Also notice this buy-sell swap that the RBI has engineered. There's been a fall in the cost of hedging up to 3 years, which has also put downward pressure on the corporate bond curve up to 3-4 years. So the sense is there is much more appetite for supply absorption here. The challenge, if at all, is at the longer end of the curve, which in the near term will not manifest.
They've also introduced new tenures at the longer end.
Yes, which is kind of normal once a year, or 1.5 times they would do that. But fundamentally, right now the market is well poised because people do expect additional easing. At some juncture, probably supply begins to overwhelm. But we are also not sanguine so much about the global policy outlook, in a sense that we expect probably policy easing at some juncture to come through. Or put another way, we are not that sanguine about growth outlooks. We think growth is slowing globally. It's a synchronized slowdown. And so far that is in play. The appetite for duration here will also be well anchored.
Just to get in your point of view, while inflation is anchored at this point in time, over the next 2 years till FY21, FY22, expectations from most quarters is that inflation will start to move up. And you will have it inching back towards that bandwidth of about 4%. In light of that, front-ending your interest rate cuts, is that something that is?
So, if suppose inflation ultimately moves to 4.25, or let's say 4 and 4.5, where we are in the global business cycle, you can easily argue for incremental easing. And probably incremental easing of the order of the 50 or 75 basis over the course of the year that I mentioned. Simply because so India never developed a real rate framework as probably it should have, because when you are inflation targeting and when that inflation variable is reasonably volatile, you probably need something that you can target better, which could be a real rate markup over where CPI is. But historically, what we have seen is somewhere in the 1/4, 1/2 vicinity of real positive rate over CPI would probably be okay, given where we are in the business cycle.
So here's one final question really on this note then. What happens going ahead if what you say turns out to be true, that the Fed is a lot more dovish than what the street believes even right now? And what kind of impact does it have on the money market flows? The equity market flows are one thing, and we've seen, after a really long time, I've seen the equity market flows being a precursor of sorts. Usually in 2018 and 17, the bond markets at first started the inflows, and then equity markets were the beneficiaries as a result of that. This time around, it's been slightly different. What happens over the course of the next 9 months to foreign flows into Indian debt?
And just to add to that, the last few months before the crisis actually started, and even during that period, the funds that flowed into the government bonds were the bigger pie, the share of the pie, bigger share of the pie. What happens if there is volatility within the bond markets for investments into?
So, the market expectation with respect to the Fed is now aligning towards easing. So if you see, where the traded futures for Fed funds are, there is easing starting to get built in. And our sense is, given where we are on the global business cycle, that's probably right. Now, one doesn't know how much inertia would happen before such a step gets taken, and the assumption here is that there is no U-shaped kind of recovery out of what we are seeing, because it looks like a synchronized global slowdown. Now, let's assume that the path of Fed expected easing continues. It's obviously quite robust for financial flows into emerging markets, especially emerging market debt, and especially the high carry emerging markets that have largely reasonably strong macros, and India would tick most of these boxes. There is some political risk going to the elections, but whichever dispensation comes post the election, so long as inflation targeting and fiscal consolidation remain, I don't think the bond market minds too much. Lately, we have seen stronger resumption in flow into the corporate bond market compared to the government bond market, which is also an indicator that the chase for carry is well and truly begun again, and that globally investors are much more sanguine about the backdrop, probably courtesy the dovish stance from the two major central bankers.
All right. Okay, Suyash, we'll leave it at that. Thanks so much for taking the time out and speaking with us today. Appreciate you joining us in the studios.
Thank you so much.